everyone, and welcome to our YouTube channel, Moneyline with Nancy at TV. In case you're not a subscriber yet, please do subscribe. Just press the subscribe button as well as turn on the notification bell so that you can get notifications when we upload our videos. Don't also forget to subscribe and join, follow, like our other social media platforms. Of course, you're seeing it right about now. Don't also forget to share this video across your platforms. Enjoy the video. With Nancy, it is on this channel, African Independent Television. My guest is with me right now, Dr. Baba Yusuf Musa, President, Nigerian Economic Society, as well as the Director General of the West African Institute for Financial and Economic Management, YFM. Dr. Musa, good morning. Welcome to my program. First time, I wouldn't say baptism of fire. I know you can. I know you can do it on today's show. Our new president. Welcome to you, Doctor.
Thank you very much, Nancy, and good morning to all viewers.
Yes, fantastic. Now, Doctor, we have a lot to talk about. Let's begin with the inflation numbers. Headline inflation rate, according to the MBS, has fallen to 16.05%. So we've seen the disinflation in the last few months. I think it's the 7th consecutive, if I'm not mistaken. How do you interpret this disinflation trend in terms of durability? Why I'm asking that question in terms of durability is because, of course, we know that we have the harvest cycles and all of that. So I would like you to talk about that. And the second aspect of my question is, I don't know if you remember that at the beginning of this year, President Tinubu gave us an inflation target. He said it, that inflation will be at 15% at least by the end of this year.
Yes.
I'm suspecting what exactly is happening, because at that time, I spoke to some analysts on the program, some economists, doctors, and professors, and some were of the view that it's not President Tinubu's duty to set an inflation target for us. So the credibility of the NBS is also put here in question. What do you have to say about that? Do you think that the politicians are twisting the hands of technocrats, perhaps in the NBS, to be able to get that inflation at 15% by the end of this year? Over to you, Doctor.
Thank you very much, Nancy. Again, good morning to all viewers. Yeah, you're absolutely right in terms of quoting the numbers. But in terms of the credibility of the NBS, I'm very confident that they are very professional institution. If you recall, the October 2025 Consumer Price Index report reveals a significant moderation in inflation pressures across Nigeria. That makes a notable departure from the elevated trajectory that we had experienced throughout the 2024. As you rightly said, the year-on-year headline inflation was 16.05, as revealed by the NBS. That is down from the 18.02% in September 2025. But that is not to say that they are working towards the answer that was given by the president. That's not correct. But however, I think the major issue is that there's a dramatic decline. But you rightly said it in your introduction that the critical observation is that there is a base year effect. You recall that in December 2024, there was a rebasing from 2009 to 2024. So that dramatic decline in year-on-year inflation must be interpreted with significant caution. You may, even the report actually notes that the changes in the base year period has an effect. The methodological shift creates what is known as a base year effect. And so comparison of the inflation that has a base year of 2009 and another one that has a base year of 2024, you will tend to confuse some issue. But the reality check that you need to do is to look at the 12-month average inflation, which is 22.02%. And I think that gives, it provides a more accurate picture of the inflationary pressure throughout the year. But you must also consider that the core inflation persisted with underlying pressure. Remember that the core inflation, which is the all item less farm produce and energy, provide insight into the underlying price pressures, excluding the volatility of food and energy component. And when you look at the year-on-year inflation, it was, I think, 18.69%. That has a critical implication because the core inflation exceeding the headline inflation is economically significant. It suggests that there are structural rigidities, meaning that non-food and non-energy prices remain sticky and elevated. And there is also demand-side pressure. It persisted, meaning that despite the monetary tightening, underlying demand, it continues to push prices upward. And the cost push factors also, that is that the exchange rate pass-through, wage pressures and imported inflation remain embodied in the numbers they have provided. Also that there is a limited monetary policy effectiveness, meaning the CBN rate hike may also be having minimal impact in the core price dynamics. So this divergence actually indicates that the moderation in the headline inflation is primarily driven by food prices stabilization, possibly, as you put it, the seasonal effect, and which is temporary, rather than the fundamental discretionary dynamics in the broader economy.
So how do you think that the Nigerian public should interpret these numbers moving forward? Of course, we are gradually approaching the end of the year, and the end of the year is characterized by a little bit of elevated price pressures. You know,
Yes.
prices of food will go up or some other commodities. Then the aspect of the core inflation, which I like the way that you put it, it moderated to, I think, 18.69%, but it's still showing us that there's a bit of stickiness. So this inflation trend that we are seeing, I don't want to say it's perhaps genuine improvement or perhaps statistical or seasonal reprieve, as I may put it. So putting all of this together, how should we as the public interpret it, bearing in mind that we just have a few weeks or perhaps a few days to the end of the year or to the Christmas season?
So if I may put it this way, is both the general public and the government also need to be concerned about the red flags. The red flags meaning that the core inflation persistent is there. 18.69 core inflation indicates structural problem, and it remains unresolved. And if you look at the month-on-month increase by 9.3%, 0.93% monthly inflation, annualizes the it annualizes this to over 11%, which is still elevated. And the report also clearly shows geographical inequality. More than 10+ percentage point spread between the states. It indicates some policy ineffectiveness. And we also, as I mentioned earlier, have to look at the base year distortion, because true inflation picture may be obscured by methodological changes that they have applied. For me, there is a need for central bank to respond also properly, because the core inflation at 18.69 remain well elevated. So there is need to anchor expectation with prevent resurgence. But the argument for cautious easing also matters, because headline inflation is declining towards the mid-teens if you look at it properly. The food inflation suggests supply side improvement, quite all right, but high interest rate constrain productive investment, and therefore there's limited monetary policy transmission in the real economy. It also has fiscal imperatives, meaning the target food security intervention need to be addressed. We need to address the regional disparities through strategic, perhaps grain reserve and distribution. We need to also reduce logistic costs to dampen inflation transmission, because it clearly shows it. Also, in terms of the energy, we need to stabilize the electricity, fuel supply, and reduce other. Then finally, also, we need to improve the security, because if you don't restore agricultural production in the conflict-afflicted area, you will always see this disruption.
Yeah, Doctor, I like that you even brought up the issue of security. And my heart really goes out even to the people of Kebbi State, because it's such a sad situation that in the midst of all of this, 25 girls have been kidnapped from Kebbi State, a brigadier general killed, and the whole country, we can go and we sleep and we wake up, you know, and it's such. Anyway, let me not just go there, but why I brought it in is the security implications in all of this, because if our food belts are challenged with insecurity, so you can imagine what the implications would be. Doctor, I'll come back to the aspect of food disparity in regions, or food inflation disparity, or the affordability, or how expensive states are to live in. I want to bring in this aspect of Nigeria's debt trajectory, because I did talk about it at the beginning during my monologue. Nigeria's debt stands at 152 trillion naira, external debt at 71.8 trillion naira, domestic debt, I'm looking at the numbers very critically according to DMO, so they are not my numbers, 80.5 trillion naira. From your own assessment, if looking at these numbers, as a country, do we really face a debt sustainability challenge or a debt management challenge? Dr. Musa, you know, we were on a, we were on a webinar on, was it on Saturday evening? And
Yes.
it was a heated webinar, you know, which I moderated. So I want to bring in that question here again in terms of, at least for the benefit of Nigerians, because just a handful of us were there on that webinar. Do we have a debt sustainability challenge or a debt management challenge? And what indicators should we be paying closer look at? Perhaps interest to revenue ratio, refinancing risk, or even maturity concentration? Very quickly, Doctor. Perhaps in 2 minutes,
All right.
because I have other
Thank you very
questions for
much.
you.
Thank you very much, Nancy. Let me maybe clarify certain issues. What we have in Nigeria is actually a revenue challenge, not a debt sustainability challenge. And remember, we are now a middle-income country, and which by middle-income country we mean we are a market access country. We do not have access to concessional financing as we used to have before. So with the scale of development and growth that Nigeria aspires to achieve, particularly in our ambition to be ranked among the world 20 top economies by 2030, we need massive and sustained investment inflow into the country. These inflows must come from debt-creating flows and non-debt creating flows, which is private capital, including the foreign direct investment, portfolio investment, and long-term infrastructure. So in this context, it is no longer adequate for us to limit the assessment of public debt sustainability solely on debt to GDP ratio. This is a metric that, of course, most countries use, including our peers. But what is pertinent to Nigeria, and which, if you look at the latest debt sustainability analysis that was done by the International Monetary Fund, IMF, under the Article 4, and which was published in July 2025, some few months back, you realize that they use a forward-looking analysis through a template called Sovereign Risk Market Access Debt Sustainability Framework. That is the framework that we should be using to assess debt sustainability for Nigeria, looking at the type of investment we need and our status in the global economy. You know, we are stick with the whole idea of the debt to GDP ratio, where we have the threshold put at 70% internationally. But this new methodology actually looks at market access. So it is more risk-based. It looks at the uncertainty that Nigerian economy is going to face. So what I tried to say, even during that seminar, is that we are no longer a low-income country. So our sustainability assessment should be sovereign risk market access based, and in which you look at when you look at Turkey, you look at India, you look at Brazil, they all adopt this methodology. It is distinct from the LIC approach in 5 different ways. The LIC usually have concessional loans in their portfolio. In our case, which is middle-income countries, we have access to only international bond markets, capital market, or semi-concessional funds. So that distinct financing sources differ us with the leak analysis. In terms of institutional strength, now we have generally have more stable institutions and greater governance in our debt architecture. And of course, we also face different shock scenarios between the leak and the marks. So as at now, as I mentioned earlier, what we are looking at more in our methodology is more focusing on commodity export dependence, less of pronounced, which is less pronounced in the leak. We look at the kind of dependence where with the risk that we are facing in terms of our external volatility outlook. So the methodology differs and the focus differs. So I think we need to, and the DMO need to educate Nigerians more. And I believe that in no distant future, they will also adapt the sovereign rate market access countries, which involve a different analysis to meet our debt obligation. In this case, you look it adopts a fund chart approach. So the way you analyze it is completely different. So where we are sticking to this debt to GDP approach, saying that we're breaching the threshold or not breaching the threshold, in the kind of investment that we need and our aspiration, I think we need to think beyond this type of approaches.
Okay, Doctor, with our debt at 152 trillion naira, with the level
Yes.
it is at, do you think it can support growth and jobs, quality jobs, like I said at the beginning, not 1 hour a week job or 1 hour, whatever matrix that the MBS put? Because
I think it should be able, but it should be able to support the job creation. But what we need more, as I mentioned to you earlier, is we really, really need to attract more investment in form of FDI that are debt creating and non-debt creating. So this is what we need to really, really bring more jobs into our country. In terms of restoring employment, I think Nigeria unemployment challenge is, we have to look at it as a structural. It is multidimensional, and it is linked actually to the low productivity, insecurity that we've been having, and the weak industrialization that we are experiencing. So for me, what we need to do to restore how to create employment, since you ask what should we do, I think we need to restore security and open up the production zones in the country. So no economy creates job in an atmosphere of pervasive insecurity. Therefore, we need to modernize our security forces. We need to deploy, more specialized security, secure our farmlands and reopen the abandoned agricultural belts that we've abandoned for a number of years. The impact will restore our agriculture, and it will also improve even tourism. We need also aggressive industrialization, especially local value addition in our production. This will also create employment, because generally manufacturing has the highest employment multiplier. For every 1 job in manufacturing, it creates 2 to 3 additional jobs in form of logistics, in form of distribution and services. We need to also, as I mentioned, revolutionize our modernize it so that we can expand our output. We need reforms even in our education system to align to industry requirement, because the kind of products that our university turn out are not employment ready. Okay. So there are several opportunities that we need to actually create employment. And I have specific recommendation, if you will allow me to.
Yes, that's actually where I'm going to perhaps take a look at what sectors, given the inflation trends, the debt dynamics that we're seeing, the macroeconomic reforms, what kind of sectors can give us those quick jobs or that quick growth that we want?
So for me, in fact, I've always advocated for Nigeria to create digital village. Let's create what we call the digital village initiative in the 6 geopolitical
Zones.
zone. When you look at the number of youths that we are actually sitting on a gold mine of youth talents. Millions of Nigerian youths with incredible, soft skills. Creativity is there, digital literacy is there, but they are trapped because they can't innovate because of three basic things. They don't have space, they don't have infrastructure, and the ecosystem is not supporting them. So if I'm to propose, I'm proposing that let's create what we call digital villages across the six geopolitical zone. With what I mean by the digital village is that we create a hub where we push those youths to, bring out the skills and the innovations they have. Remember that Lagos created a hub in some years back. That startup, just one hub, it was able to attract or raise $60 million. You remember Paystack and Fruitware? Yeah, Paystack and Fruitware actually came out of that. So remember, in just one hub, just one created by Lagos, it attracted 60 million. Just imagine if we have 6 of those in our geopolitical zones. So for me, I think the government needs to have a strategy to address that. All what the government needs to do is to provide the land, basic infrastructure, reliable internet, electricity, and a workplace. And step back, you will see a lot of innovation.
Okay.
Honestly, you will see that investors will come and listen. And finally, we are all talking about security challenges, and I think in the security in our armed forces, that will solve our problem. Nigeria, we face a significant storm of challenges, but paradoxically, it presents us, in my view, a perfect opportunity. To also, yes, yeah. That's the thing.
Okay.
Yeah, because for me, if we revolutionize our armed forces, which is less than 300,000 now, with these youths that we have, we need to modernize those, the armed forces and employ the youths and put them there so that they, be able to fight with the modern equipment. We have a lot of engineers, graduates. You have computer graduates. You have all kinds of soft skills that modern warfare require. So if we bring them, it is just easy to train them, and they will. We no longer go and fight with fiscal. You all go and fight through with drones and other things.
Okay.
And we have enough skills there.
Doctor, just in a minute, the MPC will meet next week. Given the current macroeconomic conditions, disinflation, do you think that the current macroeconomic condition will support further monetary easing, or do you think that the MPC will come with a cautious tone, bearing in mind that we've seen a month-on-month uptick in inflation? Then finally, the disparity that you talked about in terms of affordability that we're seeing in states, what kind of macroeconomic or structural factors explain this inequality that we're seeing in states across Nigeria? A minute and we just have to go.
Right. Okay, Nancy. With the meeting of the NPC, the Monetary Policy Committee of the Central Bank of Nigeria, the current relevant data and background should be considered. When you look at headline inflation in Nigeria, though it has eased to 16.05 in October 2025, down from 18.02, but food inflation, which is a large component of the CPI, also dropped by 13.12%. So what I expect, given those facts, and of course that the CBN had cut monetary policy rate in September to, I think, from 27.5 to about 27, yes, about just 50%, minus 50% basis point. So given those facts, the next week meeting, in my view, which is scheduled, I think, for 24th and 25th of November, we will on several trade-offs. They are definitely going to look at the interest rate, especially interest rate policy, that's the NPR and the corridor. With inflation showing sign of moderation, there will be some market expectation of a possible maybe further cut of the NPR, at least in a single easy. However, MPC is likely to also be cautious given the structural inflation risk. So we expect a modest, at least a modest rate cut, maybe between 25 to 50 basis points. But this is just my
Your view, yes. Doctor, about the area issue of the disparity across states. In just one sentence, if you can, we've got to go.
The disparity across states it actually stems from the issue of insecurity. So once we address that insecurity issue, it will definitely open up and actually improve our agricultural production. Because most of the zones that are affected heavily are all agricultural areas. Yes, they are food belt, yes.
Okay.
Yes.
Thank you very much, Doctor, for joining us today on the program. This is your first, I know it will not be your last. President, our Presido.
Yes. Thank you.
Thank you very much.
Nancy.
Thank you very much, Doctor.
Yeah, thank you.
All right, I've been speaking with Dr. Baba Yusuf Musa. He's the president, Nigerian Economic Society, NES. That's a body where all the economists in this country are, brilliant minds. And he's also the Director General West African Institute of Financial and Economic Management, YFM. All right, that's the much we can take on today's edition of the program. Thank you all for joining us. Please join us again tomorrow. I'll be here same time tomorrow. Have a good day. Be the best you can be. Be the change that you want to see. I am Nancy Naji. Bye for now. Thank you for making it up to this minute watching the video. Thank you all. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy TV. Like, follow all our other social media platforms where we keep you up to speed with fantastic interviews, as well as markets, personal finance, business, and economy information. This is the best place to be. I'll see you all again in the next video.